Thank you for joining us for our webinar, Retirement Planning for Your Family Business, hosted by Cranes Cleveland Business and presented by the Ahola Corporation. I'm Michelle Sestar with Cranes Cleveland Business. As a reminder, the presentation is being recorded and will be available to rewatch tomorrow, along with a download of the slide presentation. Watch your email for the link. The webinar will be 60 minutes, including a presentation from our speakers and a question and answer session. You can submit a question at any time throughout the webinar by typing it in the question field to the right of your screen. We will hold a Q&A session at the end where we will try to answer as many questions as possible. Our webinar will be presented by Eileen Vitale and Jeff Ahola. Eileen Vitale is a principal in HW&Co's Tax Advisors Group and holds the appellation's Certified Financial Planner, Professional, and Accredited Estate Planner designation. She advises high net worth individuals in employee benefit plans. Eileen also advises family-owned businesses and trusts. She is a frequent speaker on estate, financial planning, and other various tax topics. Jeff is the CEO at the Ahola Corporation, where he holds the primary responsibility for charting the strategic direction of the company his parents founded while fulfilling its mission to help other family businesses succeed. He also oversees Ahola's sales and marketing efforts, a role he has held since 1984 when he joined the family business. Under Jeff's leadership, the company has secured its marketplace position as a top provider of family-focused payroll and human capital management systems. I will now pass it over to Eileen and Jeff, who will get things started.
Good afternoon, everybody. This is Jeff Ahola, and I'd just like to talk about our agenda for the next hour. We're going to review the primary stages of a family business as our focus of the first part of this program. We're going to talk about the three most common stages that you most likely will be in or entering into, and we will then later on in the program give you a poll to find out exactly what stage you're in based on our definitions. We're going to explain the key retirement options based on what stage you are in your family business and what goals your family has in the discussions and planning sessions that you've had in the past. We're also going to provide you some key takeaway items, some action items for your retirement planning, and we're going to wrap everything up and give you some takeaways to follow through with professionals that you have in your Rolodex. So we'd like to talk a little bit about the definition of a family business. Is your company a family business? That's a great question. It's a very difficult question to ask and answer. You probably know if you consider yourself a family business or not. It is there's a lot of dialogue in the family business space about a common definition, and there has been quite a few things that make that a very complex question. One of the ways that we want to talk about this is how does the IRS define a business, whether it's family or not. And you'll see on your monitor that there are primarily three legal forms of an organization that can define what type of employee benefit plan you could be involved in, and as if you're an owner or officer of that corporation or organization, how you can participate in these kind of plans. There truly is no definition by the IRS of a family business, but there are a multitude of related party rules that are very interesting to understand and go through. The marketplace for a business owning family is rather huge. I was rather shocked in my studies to learn how large of a market the family business space is in. And if you look at your screen, when you look at the outer circle of Dr. Joe Astrakhan's picture of family business, there are approximately over 30 million businesses that have family participation, which includes control of the direction of the business. That's a very huge number, and that's just U.S. numbers alone. In the center of that circle would be what we focus on at Ahola, which are truly family employers. A family business is different than a family employer. Someone that employs people other than shareholders or owners truly becomes more complex in the marketplace. Being a family owner in that center section, there are approximately 5.6 million family-owned employers just in the United States alone. So somewhere between a founder or descendant running a family company, that second set of circles there, it's somewhere between 15 to 17 million businesses in that space there. So, you know, there are quite a few multiple generation family businesses today because of baby boomers' parents starting businesses after World War II. These numbers are rather staggering, and we'd like for you to understand these different stages on where you're starting and where you're heading. And understanding these stages is information you've probably never been presented before because this is very unique research.
So one of the things, Jeff, that you need to look at is when you're talking about where you're starting and where you're going, obviously, if you're in any one of these stages, is you're looking toward retirement or transition of your business and where do you want it to go. And the earlier you start looking at that transition and your retirement, the better off you are. And for a number of reasons. One is making sure you have people in place, but secondarily is how are you going to fund whatever you're going to do. If you're the entrepreneur, the co-preneur, the parent offspring, or something, you're going to talk about these. But if you're going to go through those and you're going to say, I'm going to pass this on to someone else or am I going to sell it, how is that going to be funded? And particularly if some of it is going to be funded within the family, then you really want to look at starting earlier. And one of the things that's very important when we talk about retirement plans is compounding of the assets that you're going to put in a retirement plan. When do we start? And starting now makes a big difference. And one of the things, if I give two examples when we look at retirement plans for clients, is if you look at two people who start putting away for retirement at the same time, and one person puts $100 a month away for 30 years, and it compounds at 5%, at the end of that 30 years, it's just under $7,000 that they have. So they've put away a total of $3,000. It's worth $7,000 at the end of 30 years at 5%. Markedly different is if that same person puts away that same $3,000 today and lets it just sit for 30 years, doesn't ever add another cent, it's going to be worth almost $14,000. So it really is something you should, from a financial side, without even looking at all the other things, you should definitely start that earlier and think about doing it now.
Yeah, the earlier the better. So, great. So what stage might you be in? So let's just discuss a few of the stages and how a family business actually becomes a family business. So typically, and there are some cases where it's not the case, the business starts out as a solo entrepreneur. Someone has a dream to start a business, and they strike out on their own, and they create an entity. Typically, it starts out as perhaps a sole proprietorship and doesn't become a corporation until later on in its life cycle. But an entrepreneur has to have the courage and the dream and the passion to go start a business. And it's a very difficult thing to do. And you know, I salute those people that start those businesses because it's a very difficult thing to get going. So after the entrepreneurial stage, really truly the first stage of a family business is what people in the academic space of family business consider what's called a co-preneur phase. And a co-preneur phase is typically going to be spouses getting together and working. You know, it could be brothers working, it could be cousins, nieces, nephews. It could be any related party getting to a stage where they're sharing in an important asset called the business. But once again, the co-preneur phase is most common, with it being family businesses, typically spouses. Have you seen that?
Yes, we see that a lot because it's cheaper to employ your spouse than to go out and pay someone else.
Yep.
So we see that a lot. Like I have insurance agencies where the insurance agent is dad and mom does all the books, or mom does something else. So a lot of things like that.
Yep.
Definitely.
Great. And then the next stage after the co-preneur phase is considered the parent offspring phase. And this is very close and personal to the Aholas because, you know, we've been through all these stages, but the parent offspring phase is most typically what's considered primogeniture, which is the oldest son inherits the business or inherits the assets of the family and takes over that business. Those days are gone. I can't even say that they're changing. They're gone. There are more and more, not just the oldest son, but the second or third oldest son, or any of the daughters are heavily involved in family businesses. As a matter of fact, one of the most important differences about family companies is there are more female CEOs in family companies than in any other entity type in the United States. So the family trusts the leadership of the spouses, and it's a very, very important phase. But typically it's usually one offspring, typically of 3 descendants of an entrepreneur. The most common research is 2 of the 3 offsprings get involved in the family business. So after the parent offspring phase, we enter what's called the sibling partnership phase. And the sibling partnership phase is very common as well. If there's 3 siblings, 2 of the 3 typically get involved in the family business. One of them typically is I call him the dentist from Denver, doesn't want to be involved in the family company, doesn't live locally with where the business is, and they're involved in other dreams and passions that they're pursuing. It's rare, that all siblings get involved in the family company, but at Ahola, that's how it worked out with us. And we've got quite a few interesting stories along that path there. The next,
I think, Jeff, that's probably in large part if you get past the parent offspring, because a lot of times you may not have that offspring that even wants to come in.
Right.
I had a client like that we just sold because we didn't have that. But I see when you get to that sibling partnership, that's where you oftentimes have the most struggles within the family partnership. Because if you make it past here, you get to the next one, you're going to have some additional issues. But just among siblings, particularly if they're not all in the business, because sometimes you'll get outside people, outside parties that have a lot of input into that. You start getting, spouses and all kinds of things who can do things. I had one client where they literally split the business between 2 brothers.
Yeah.
There was the same business. They literally had to split it because the wives couldn't get along. Mm-hmm. So sometimes it's just things like that.
Yeah, and it's very common to see businesses create operating units based on the personalities and the interest level of the family members. So they typically get to that stage and make things happen. So the sibling partnership phase, very near and dear to my heart at the Ahola Corporation. And then the next phase of the family business or stage is considered the cousins collaboration or the cousins consortium phase. So cousins getting involved in typically either owning the business exclusively and having non-family leadership running the business, or in a lot of cases, the cousins are actively involved in the business, and there's additional complications that happen in that phase as well.
Right, you get lots more friction that can come up.
Absolutely, a lot of personalities. And then the most elaborate phase would be the last stage, would be a dynastic family phase, and the dynastic family is firms like SC Johnson Wax and Smuckers and some of these other well-known family brands that are out there. So what we'd like you to do is, based on framing those stages there, we'd like you to start thinking about what stage is your family business in, and it most likely would be best to identify yourself on the stage that you've been in the longest, or if you've just entered a new stage. It's important the precursor and the end of the stages to understand some of the nuances going on in the retirement planning world based on that stage.
So we're going to do a poll right now as to answer those questions so that we can really look and see where everyone is that's on the line.
Great. So if you could take a second to talk about the stage of your family business. If you're an advisor or someone else outside of a family business, use an example of somebody that you are familiar with. That would be fantastic.
All right, you guys, we have a lot of people that have voted so far. Again, the poll on your screen right now, what stage is your family business currently in? 36% is entrepreneur. It looks like 27% is tied for both co-preneur and parent offspring, and 7% is also tied for sibling partnership and cousins collaboration.
Fantastic. And today we kind of assumed that we were going to focus on 3 of the most common that we thought phases. So if you're an entrepreneurial phase, consider the copreneur phase as the closest for your analysis. But we're going to focus on copreneur, parent offspring, and sibling partnership phase as our discussion. Okay, copreneur phase, typically called lovingly and not so lovingly mom and pop shops. Okay, it's very common that families work together. It's a worldwide phenomena. It's not just a U.S. type of phenomena. It is very common in other parts of the world, especially in Europe, to have multiple generations of copreneurs involved. And you could stay in that phase in perpetuity. You know, you might stay in that phase where you gift that business to someone in the family, and they become and stay in that copreneur phase generation after generation. You'll see on the screen, we talk a little bit about it represents about 30% of existing firms. Because there are so many small firms, it skews the numbers to show how big that is. But it's a very huge number in the United States. And some people view it as a way of life versus an economic unit. So it could be more of a lifestyle choice of a business versus a truly an economic engine that some companies are.
Right.
Your thoughts on that?
Oh, I definitely see that. We have a lot of copreneurs that literally, as you said, they pass it down from one generation to the next because maybe there is only one, and maybe they give other assets outside of this entity to others if there are other siblings, but one individual may take it in each generation, not because they have to, but because of everyone's interest, particularly today where people have such diverse interests.
Yep, absolutely. So let's move to talk a little bit about some of the solutions that you see in your professional work.
Well, what we're going to do is talk a little bit about some of the plans we see the most in some of the in the different stages that are out there. So as Jeff said, if you're in the entrepreneurial stage versus the copreneur, these can be oftentimes very similar because, as Jeff said, generally they're mom and pop, so it's spouses. And most plans that would work in the case of an entrepreneur alone will work here too. So sometimes we look and it just doesn't, especially when you're first starting out, it just does not make sense to actually put in a qualified plan because you're just getting started. You're trying to put almost every dollar back into the business. Mm-hmm. And so you want to put a little bit of money away to, as I said, get started as soon as you can. So it's good to do something.
So the compounding effect of money.
Right. So you want to do something. So in those cases where you have no company plan, and maybe you at this point don't even have any other employees, you know, you can use an IRA. And so that you can at least put $5,500 a year away for yourself and your spouse, because your spouse can contribute even if they don't work for the company, and they can do that. And if you're over 50, you can put $6,500 away. So it's not as much as you can put in a qualified plan, but if that's your only option, and it's better that you invest in the company than put it away, then this might be where you want to do, where you want to go. The next couple of plans are really for, we see on those who are just getting started in putting in retirement plans. And they may have some employees who are looking for one, they're trying to get one, or even if it's just still mom and pop, they have the ability to put more away. So they don't need to reinvest everything they have. They may be making significant dollars because just because it's a small business doesn't mean their bottom line isn't large.
And the SEP-IRA stands for Simplified
Employee Plan.
Okay.
Yes. And this is probably the most, and I'm going to talk about a simple IRA, but this is the most simple plan that's been out there for a long time. And it literally, there is a federal form that you can use to put one in place, and then you just go and open your account. It's that simple. And if you have other employees, you do the same. You use one plan and you just open accounts for each one of them for them. And this is, in the case of this, if you have employees, the people who are eligible are those who are age 21 and over, earning $600 or more than $600 in the previous year, and have worked for you 3 of the last 5 years. So a lot of times what we see is companies are just getting started and they may not be ready to put their employees in. Maybe they can't afford to put their employees in yet, but they can put them in. So it's just, or if you have a lot of turnover, it doesn't cost you as much, and yet the principal can get more contributions for themselves, because in this case, you can put away 20% of your earnings up to $55,000 for this year in 2018.
So can a business owner, as they build an IRA like that, can they roll that into a qualified 401k plan down the road?
Yes.
Okay.
Everything, as of a number of years ago, all of these plans, you can roll assets from one to another. Even from an IRA, standalone IRA, you can roll into a plan as long as the plan allows it. And for the most part, all plans allow rollovers. Okay. There are some exceptions, but they really are related to where you have after-tax contributions, and we can talk about that. The simple IRA is the next one we see a lot in small businesses, and this allows them to make eligible or contributions for eligible employees who've earned more than $5,000 in the last 2 years. So you can see that the eligibility is slightly different, and they have to have earned that in the last 2 years, excuse me, and they're expected to do that in the current year. So if they did, they probably do this, will qualify this year. So if you look at both of these, for the most part, you could have employees who are part-time who will be eligible for contributions. And sometimes in a lot of these businesses, you use a lot of part-time employees, we find, and I'm sure you do too, Jeff, in your business to get it going. And so you don't have that vast overhead, and so it allows for that. Now, the one trade-off between, in a SEP IRA, those contributions every year are not mandatory, they are optional.
They're optional.
So you can change what you contribute each year. When you do a simple IRA, then you can, you have to do a contribution for your participants. So for employee deferrals up to $12,500, and you can add another what's called a catch-up contribution. That's that $3,000 if you're over 50%. You either have to match dollar for dollar at 3%.
The employer is required to match that money.
Correct.
Okay.
Or you can make a 2% profit sharing contribution. So what's the difference? For those who aren't familiar with them, if you do the match option, you are only putting that 3% match in for those who actually defer. So for whatever employees you have who participate and actually defer into the plan. In the other option, the 2% profit sharing, whether your participants contribute or not, you will give 2% across the board to everyone who is eligible.
All eligible.
All eligible employees. So it can sometimes come out to be a significantly different number, but one of the things we find in talking with clients and looking at which they should choose is really who are they trying to benefit, who is their workforce, are they going to contribute, and what are you really trying to do? We go from, I talk to clients who really their total goal is themselves, and so if they have to contribute for participants and employees because of that, then so be it. But then I also have employers who literally what they're trying to do is just contribute for the employees. That's more important to them because it's how they attract and retain employees.
Right.
So, and I'm sure you see this quite a bit too in your family businesses that you deal with. So what does that get you? You put that away. Well, what it does is it allows the employer, if you use a simple IRA, it allows them to defer without what we call testing, which I'll talk about in a little while. But what it does is it talks about discrimination. Discrimination testing. So you have to make sure that generally when you're in a plan, and I'll talk about this in the profit sharing in a moment, you have to make sure that you are actually contributing at a level that's allowed under the rules. There's very specific rules.
And the rules are very complex for family companies or related parties working together.
Right.
Specifically lineal ascendants and descendants and some other complicated
siblings,
rules.
Yes. Especially if both parents work in the business or people and their spouses at the next generation.
When you have multiple generations, you may have the founder, the founder's son, the founder's grandson. You have multiple generations working together, and the IRS looks at those rules differently.
Right, and particularly even if you have in-laws and individuals like that in there.
Right.
So you have to look at those. And so what it does is some people want to be able to contribute, but they say, you know what, I want to be able to have everybody contribute on their own because I don't want to deal with all of that. And at this, we generally are finding in a lot of cases, you know, a lot of smaller businesses fit this footprint, and so they want to do this. Now, there are some specific rules that you have to meet. If you have a simple plan, you can't have any other plan at the same time, and things like that. So you have to look at that, but it's definitely something to consider if you don't have a plan.
So if you want to move from a simple IRA to a 401k, you've got to close that simple out and either roll assets
at the end of a year.
Okay.
And you have to look at that in a calendar year.
Okay.
So if you have a fiscal year plan, you have to really look at that.
Okay.
And there's some timing. So, but again, this fits this footprint very well. The next option we have is what would fall under a defined contribution plan. And this can be a number of different plans, but we're going to talk about the ones that have the most flexibility right now. And the first is a profit sharing plan that I want to talk about. In this, if you look, the eligibility is significantly different than what we had in the other two. So it's going to be any employee age 21. Now that's the maximum. You can have, for example, in our plan, we have no age limitations. So if we have an 18-year-old start, we can do that.
As part of the plan document.
As part of the plan document.
Set that up.
Yes.
Custom for each client.
Right. So we can do that. Usually, if you're doing a standardized plan, one of the options is pick your age, and it just can't be more than 21. So when I say what that is, in this case, that's the maximum eligibility.
Okay.
And 1 year of service. Again, that could be, we have some plans that people start the day they start. I'm not a big fan of those because it's a lot of administration and can truly affect your discrimination testing and your contributions. But so 1 year of service, or at least some period to make sure the person's going to stay, especially in today's day and age where people switch jobs continuously.
Got it.
In this, similar to what you have in the SEP IRA, you can put away up to $55,000, and it's 25% of compensation that you can use to do that.
Okay.
So, and what this does is it allows you, the employer, there's no employee contribution here, that it allows the employer to put away whatever they're going to put away for all their participants. And there's some things you can do that are what are called allowed discrimination. Just know that there are some things. It doesn't have to be a ratable contribution. So depending on what the circumstances of each plan are would determine how you would set that up and things. Now there's one we didn't list here, but it also falls under, we didn't list it out separately. It is another defined contribution plan that you often don't see at these early stages, the entrepreneur, copreneur, until they get a little larger, which is a 401k. And we'll talk about that a little bit later. But one way when we talk about that, I'd like you to just keep in mind is there is now available what is called a 401k MEP, or a multiple employer plan. So that businesses that are smaller generally don't put in 401ks for one reason. It's very expensive. You can't get the dollar bang for your buck for putting that money away. And this is something that allows you to go with other employers that are similarly small and actually put in
a common nexus to that.
Right.
And the IRS is allowing those because they want to have people stand on their own 2 feet for retirement and not rely on Social Security.
Right.
So they adopt into an existing plan, and they get to gain the benefits of a plan that's already been, the SPD's already been created, and the testing is already part of the process.
Right, and it's approved. So it makes it so you really get that benefit of having all the additional people who are also participating.
How big of an asset size should a plan be in dollars of asset before it rolls from a simple or a 401k MEP to its own standalone plan? What do you think is a reasonable number? Is it $250,000 in assets? Is it $500,000? Is it $1 million?
It's at least $500,000.
At least $500,000. Why is that? Because of the cost?
Just because of the cost.
Okay.
The cost of doing it. Unless you're doing a plain flat out profit sharing. If you're doing anything with employer contributions, to do that 401k, to be in that 401k space, you really have to have $500,000 before you can get any cost savings, cost benefit.
And I think a lot of our people on the webinar today are trying to attract strong talent in a tight labor market. Most people don't understand this stuff because it's complex, especially employees, and they just go, I want a 401k. They don't realize that these could be just as beneficial, but it's like a common marketing, you know.
It truly is, and today a lot of employees want to put away for their future because Social Security isn't all of it, was never meant to be your entire retirement. So you really have to save for retirement. So it's really a good benefit.
That's great stuff. Okay, so we're going to talk, we've got a worksheet reminder for you guys to take some notes on. I think we emailed this to you folks, okay? And some of your action items are listed here. So I think we want to reiterate that start now, do something, because the time value of money is so important to grow your assets and add leverage, match your needs, find the right plan, those kind of things.
You want to talk to your advisors, you know, your financial advisors, your accountants, you know, what makes the most sense for your entity and for your
And if you're a family business, what stage you're in. So that moves us to parent offspring phase. So traditionally, these businesses were passed down to the oldest child. Am I on the right page here? Yep. And the oldest child would begin working in the business. At Ahola, the way it worked at Ahola, my brother Mark, who's the oldest, he was the first to join the co-preneur. So it started out, Chet Ahola started the business 51 years ago. Rita Ahola was she was the breadwinner as a nurse while the business got started, and then as the business grew, she left nursing and joined the family business. Then that stage became parent offspring when Mark Ahola joined the business. And then it became a full sibling phase when the other three siblings, myself, my sister Maria, and my brother Scott, all joined the family business to become that phase there. So typically it's not just the oldest son anymore that joins the family business. People have different goals, different dreams. But I remember when I was young, my father was disappointed that one of his vendors didn't have anybody in the family that wanted to take over the family business, and he wanted that dream to continue on. And he was that business owner was saddened that no one wanted the family business, and he ended up selling it outside the family and perhaps to his leadership team. But that's a very common thing where people want to keep that family legacy alive, and that's how the whole is think as well. So let's talk about some of the plan offerings for parent offspring that are similar to the other phases, but maybe a little bit different.
Right. Again, we have some of the same things we saw when we were entrepreneur or co-preneur, the IRA, the simple IRA. Those work the same, and again, they can still fit here depending on the size and needs of your business, what you're doing. The defined contribution, a profit sharing plan. Now, there are some other plans you can use that are require a contribution. I did not spend time going through those today because it just adds more definitive requirements that need to be addressed. So what we really aren't talking about those, but know that there are some other options out there. You could have a defined benefit plan that would be out there. But again, that would take a lot more time to talk about. That could be if you have a business where you have older participants, particularly the owners, who maybe have never put money away, and all of a sudden you have significant earnings, then you would want to look at one of those.
Okay.
So that's something to just be aware of. But in the area of profit sharing, some of the things here is now this is where you oftentimes see in profit sharing rather than ratable contributions, you'll see, because you generally have more employees at this point, and so you'll generally see a lot more issues of how do we get the people we want to benefit the most, which may or may not be the owners. Again, I mean, I have family businesses that in order to attract and retain, they actually step outside. They actually maybe excluded from the plan, they put it away in an IRA, and they use this as a means to attract others. So there's all different kinds of things, but I have, for example, one client in this where mom and dad are in the business, son, daughter-in-law, we have actually 3 kids who are in the business, and including a daughter-in-law who does provide services for the business. And she has another full-time job, but part-time she does things. She's an attorney, so she's their legal counsel. They don't pay outside lawyers, so she gets paid a salary for providing that service. And she really does work doing it. And so what they do is they have a plan that has a few more of those bells and whistles as to how that contribution is allocated, because they want to make sure that those who work in the business full-time and really are going to rely on this for their retirement, because when they transition, just as you were talking about, you know, looking at, are you going to sell it, give it, or sell it to someone outside, that, you know, what are they going to do? Well, in this case, because the next generation is very involved, they are not going to sell this outside. So one of their methods is making sure they put away enough for mom and dad.
Right.
To make sure that mom and dad aren't still trying to be a drain on the business when they're no longer there.
Yep, that's part of the complication of getting the sibling phase is
right.
You've got maybe 2, 3, 4, 5 families that you now have to worry about retirement, and that's going to be a big issue.
Right.
Can you recap? I think a lot of our listeners are interested in the typical 401k plan. So what are the 3 main costs of, let's say you don't have a plan or you've got a simple IRA and you do want to have a 401k plan? What are the 3 main costs of getting that set up? There's startup fees, there's investment fees, and there's recap those real quick for us?
Yes. Well, there's your startup fees, which can be, you know, getting the advice to get it done, making sure you're putting in the right plan. What I always make sure that clients do is don't just go in and let someone who doesn't understand what you're doing and where you're going make your choices, because
right.
most plans today are, you know, they're prototype plans, and so people are checking boxes and things they don't understand. Make sure you use someone. So that's one of your costs, as you mentioned, is having someone who knows what you're doing review that with you.
And they create the plan and create an SPD or a summary plan description of the design of the plan. So
right.
the design
What's
plan.
the plan?
Okay.
Right. And then your next cost is I would say your next cost is your administrative cost. And that
to
is
administer the assets or to
administer the actual compliance of the plan. Generally most plans use a third-party administrator, and so you have to pay for that. The fees are generally in a 401k plan are generally based on a per participant, a combined calculation per participant, a flat fee, and then most of them today also have a piece that is tied to what the assets are, in order to help keep that per participant fee down and do a good job. And this is one of the things I always tell clients, don't look at it to get it just the cheapest you can get. Make sure you got a good one. Because you really want, this is very, very key, is making sure you have a good third party administrator.
And having advisors understand these stages of family business would be valuable for them to give the correct direction to one of these plans.
Right, as to what you want, what choices you want, how you want things allocated, who are you trying to benefit, and things like that in a family business. And then the third cost is, as you alluded to, is the investment cost. And one of the things that the Department of Labor has been very, very outspoken on and has a tremendous amount of attention to right now is what the costs of the plan are, not only those first 2, but the investment cost.
So total fee disclosure is really a hot topic right now.
Yes, it is. And getting all of that, making sure your participants have it. And a lot of the fees on the investment side come out of the investment funds that are used, because you usually use mutual funds in order to do the investment side. And so those come out of there. And it comes out in part from the participants. Now, sometimes any one of those 3 costs, the advice side, the TPA, or this may be paid by the sponsor of the plan. So the employer could be paying them. These are less likely to be paid by the employer. These are generally just going to come right out of the funds.
Right.
And whereas the other ones sometimes are paid by the employer.
That's why if the plan gets bigger, the net cost typically could go down because you've got more assets to play.
Right. The more assets you have, the more they can spread it over.
Fantastic. So some of the action items, if you have a plan, I would think that you could help them compare fees. If they've got an existing plan or a TPA involved, you could help them shop that.
Right.
If they don't have a plan, you could help them discuss options to implement a plan to tie it into some of their family goals and their business goals. That's what's so unique about family businesses. You've got sometimes up to 3 systems you're dealing with: the family system, the business system, and the ownership system. And each one of those has some kinds of divergent goals. That's where how conflict sometimes happens in family companies.
Right.
So are you good with the action items there? Anything else you'd like to add on the action items?
No, I think those are really good ones.
Think we're good?
And then I think one of them, not to really make sure people understand, is that communication in a family business is just so tremendously important.
Yeah. Having those frequent family meetings to talk about strategy for the family and strategy for the business are a best practice that we'd love to share with anybody that's interested. We're going to move on to sibling partnerships. The Aholas are a sibling partnership. We are co-managing partners. A lot of times, a sibling partnership would be a caretaker. So these are subdivisions of a sibling partnership where a caretaker, where one of the siblings, typically the oldest, would own all the stock and help the family interpret a lot of decisions. Or even in some cases, a successful sibling partnership where all the siblings are owners. None of them are actively employed in the business. They use a non-family CEO and non-family leadership team. So those are the typical sibling partnership groups that we see out there. So if you could talk a little bit about some of the planning for those groups.
Yes. In this case, the plans that are out there, pretty much the same that we've seen. In the other phases, in this case, generally it's a more developed business. You're going to have more employees, things like that. So it's really not the plan itself, but it's what the plan offers and what the characteristics of the plan are that are really important when you get to this point. And looking at, should we change them? Sometimes people put in plans when they were in one of the first early stages.
And they modify it as they go along?
Yes, you really should.
Without creating a new plan. They just keep the same plan they have.
Right, and they just make modifications. And sometimes what happens is I'll get a new client and I'll look at it, and what they put in was perfect for them when they were the entrepreneur or the co-preneur, but now they're at the sibling partnership, and we have all these new dynamics of people in the plan, people out of the plan in the family that, because they work or don't work for the company. And so then sometimes it's really important to look at it and say, oh, do we need to make some changes? Do we need to change how that allocation is going to be done going forward? What are the goals? And usually by this point, we have mom and dad are gone. This plan is not helping fund their retirement anymore. Mm-hmm. Now we have this next generation, and we need to get their contributions up there. So again, depending on how you're doing your allocations in plans.
Exit at the end of this stage gets really dicey because you've got a larger family group to either onto, transfer, sell, or maybe the business has to be sold for the family to retire.
Right. So especially if you don't have that next group of generation, those cousins coming in. Mm-hmm. Sometimes people think, well, once it gets to here, it's just going to work. Well, sometimes we can all look at it and say that's just not going to work.
It might be too successful because they can't support those folks without selling.
Right. Okay. And so that's why in this case, that's where you want to really look at more what your characteristics are versus putting in a new plan.
Mm-hmm. And this phase here is where a lot of it's called the ADP, ACP testing, the discrimination testing gets really dicey. So that's when a census has to be created and sent to professionals like you that would then analyze all the related party rules in the Internal Revenue Code as it pertains to the Department of Labor regs, and you would help the clients navigate those rules.
Right, to see what makes sense based on what their situation is. We will look at it before, obviously in any plan, if you're in a 401k, you're going to do a census for the annual testing, but I think what you're talking about is doing it for that planning to see what we should put in and where we want to go, who are we benefiting.
Well, before you become out of compliance too with the plan, because you may want to ramp up. This is when confidentiality becomes so critical in the sibling phase within the payroll and the family, because you may be ramping up the deferrals because you put in a custom plan for the family to help them exit because you want to keep the business going. And sometimes those numbers can be eye-popping for someone that's looking at a payroll report. So we've put in role-based security to help with that process because it just doesn't make sense for people unless they knew what the family sacrificed to get started, and then now they want to be able to exit and keep those jobs and keep that business going. So there's a lot of dynamics involved.
Right, there are.
That phase.
Yeah, and as you said, there's a lot of things people don't understand how that works.
Right.
And they don't understand the risk takers and what they're
And
doing.
early,
And
20, 30, 50 years ago, right?
Right. And those who are still on the hook.
Right.
Because, you know, if you're just an employee and the business goes down, you go somewhere else and get a job. If you're the business owner, that's a whole different ballgame.
Now, you talked a little bit about in-laws and outlaws and others on the payroll. What are the laws when it comes to, let's say, a matriarch of a family business takes care of the family office or helps with family meetings in a family business, and they don't come into the office every day? Do they have to, like on health insurance, do they have to be typically employed in the family business to be able to benefit from the retirement plans, or are there some gray areas there? What have you seen over the years?
There are a couple of things. You either have to, and it depends on what options you choose in your plan and which plan you're in, but generally in the case of that matriarch who maybe doesn't come in every day, but really does a lot of things.
Sure,
the business,
work from their home office.
I would think they would be on the payroll.
Right.
They may not be getting paid the same, but they would be on the payroll so that they could participate.
Well, people are concerned about ghost employees, and in a family company, it becomes, again, it's another highly sensitive topic.
Right, because
where
they might
they're working on these different systems. They may be working on the family office, which is part of the family's wealth and their business, and I would consider them to be truly an employee of the organization. So,
right, and they might be out representing the company every time their spouse is out doing something for the company. So they're out there representing them. So I see no issues with that, and if they're truly doing that, and then that way they can participate. We have some where they may have participation in the plan because they are directors of the company and the director's fees are included. Now, again, that adds to additional testing if you're using how you define contribution, other ways of defining contribution, not contribution, compensation.
So directors and officers compensation.
Yes,
that kind of
those oftentimes are allowed to participate in plans as well. But as I said,
it's got to be in the summary plan description or part.
Right, it has to be part of the plan.
Check the right box when you set that.
Right, and define what your contribution or your compensation is.
Okay.
So.
Yeah, it's common, like even in the payroll world, where people think when their child comes into work and they're 8 years old, 10 years old, 12-year-old, they think they're violating child labor laws, and they're not. And that they can, a family can employ any descendant at any age, as long as it's not in a very risky profession. So a lot of interesting dynamics that we've learned along the path.
Right, and we see clients do that even just so that they can put IRAs away for children.
Yeah, yeah, we have an interesting story with the Sheetz family founder of Sheetz, the very big gasoline retailer. The moment his descendants are born, they go on the payroll. And there's nothing wrong with that. You just may not be able to deduct the tax deductibility of that expense to the corporation, but there's nothing wrong with you putting your descendants on the payroll. So interesting stuff.
Right.
Action items. Let's talk a little bit of some of the failure points. Do we have any specific horror stories that you'd like to talk about where they failed their testing and had to give money back to the plan? Have you seen a lot of that in family businesses?
We do see that sometimes, where we see, especially in the earlier stages, where there's less developed, and maybe if there are particularly significant differences in what compensation is between the top and the bottom.
Highly comp versus the non-highly comp.
Right, and that's related to the testing as opposed to if you're just making a profit sharing contribution. But a lot of times we have that happens all the time.
Okay.
So I have a plan I help with testing every year, and every year the owners get money back.
And if you do it after the year closes, you've got to do a W-2C on the payroll. Right. And that gets a little dicey because you're gifting money back to the plan. So you've got to make sure your plan's in compliance and you've got professionals helping you, because that can become, then the owners have to redo their tax returns and you've got additional tax expense. So a lot of complications there that we like to prevent with our customers. Right. We talked a little bit about related party rules and testing, succession planning goals and so forth. I think we're good with that page. Okay. All right. Well, I think we're ready to close and wrap up. Are we looking for questions here? Or we're going to talk a little bit about just recapping the stages of a family business. So as you can see on your screen there, like in the Ahola's case, Chet Ahola was the founding entrepreneur. Chet and Rita became co-preneurs. Mark Ahola joined the family business, became a parent offspring phase. Then my two siblings joined Mark, and there's 3 of the 4 siblings were there. And then while I was working at Progressive I then joined and filled in the final piece of the sibling partnership, and now we've got Sonia Ahola, who's involved in the cousins phase in the family business, and so we can attest to these phases. We've lived them all and seen the issues that go along the path. It's pretty exciting to see all these different stages. We hope to become a dynastic family someday. So, but those are the key stages of a family business, and it's good to have your advisors understand this. And if it's a financial advisor, or insurance, legal, accounting, psychological, whatever, understanding these phases and stages are very valuable to everybody in the family and those key advisors with the family. So we're excited to share that knowledge and information with you folks today. So I think we're starting to wrap up. We might have a couple questions coming in here online. Feel free to keep any questions coming in, and we'd like to move to that stage right now. So.
All right, you guys, I see some questions coming in right now. The first one that we have, I don't have a retirement plan. Which plan is the most affordable and the easiest to administer?
Well, the most affordable can be defined in a lot of different ways as to how you think that, because you may say, I don't want to pay any expenses, but that may be the least affordable because you're not going to have anything put away for retirement. So you have to look at that and measure that against what your goal is. But I think the easiest one clearly to do, if you're talking about a company as opposed to an IRA, a company plan is either if you're making no employee contributions, so it's only the employer, would be a SEP. If you are making employer and employee contributions, the easiest one would be a simple. So, and they go up from there.
Okay.
All right, the next question, how do you manage expectations of siblings involved and not involved in the business as to family transition?
That's a very dicey question, but a great question. I would suggest that if that's the case, you find a professional meeting facilitator, and there are people at the FFI Institute. We've got some people in the Galliards group. We would happy to refer some people, but beginning the stage of a family meeting on a regular basis, one of the best practices for family companies is to have frequent family meetings, 3 to 6 of them per year, have an outside board of advisors. A board could be helpful in some of that discussion as well, depending on who's on your board, and do strategic planning through processes like Traction and Strategic Coach and some others out there. But those are the 3 best practices for family companies. But I would suggest that the family meeting to discuss the dreams of each of the participants and how to, the founding generation wants to make it equal, but it probably won't be fair. So, there's a balancing act that has to be done there to take care of things. We see a lot of cases where we've got a separate corporation set up for real estate. We've got separate businesses set up because of family interests, and trying to make things equal is a very difficult thing for a family to go through. So.
All right, we have another question. My employees are averse to contributing to a plan. How can I help them see the value in retirement planning?
I think that's really a case of education. I think if you educate your employees so that they understand what it does, so they understand compounding and saving for their own retirement, and the fact that that responsibility is theirs. No one's going to do it for them. You're going to help them as an employer along the way. And so again, I come back to it's educating them so they understand how it can work. And that whole thing we talked about at the very beginning with compounding, and the earlier they start saving for themselves, the better off they'll be, as well as the fact that what I tell people when I do 401k meetings, and I'm doing it with participants, is the more you take out of your paycheck, every time you get a raise, you should put money away. I mean, it's explaining these kind of things so that they understand, because money you never see is never spent, and you will have it then at the end. And
recently there's been enhancements to the plans where you can automatically take money out of employees.
Right.
If you have your plan designed that way, and that encourages them to invest, especially when they see the stock market and they're not participating in it. And it's a good time to educate them on that.
Right, and I think in educating them as to what the different options are for investments, and making sure your plan has the right investment alternatives for your your employee group. Sometimes, and we have some plans where literally their people have no idea. They would be so underserved by picking among mutual funds. And so some of them use all date funds. Based on birth date and when your retirement is, because those are then actively managed by whoever is managing that fund, and they go through them. So it's, there's a lot of different things there, and I think really having them understand that and understand putting that money away, even if it's, in some cases, someone is making minimum wage, if they put away $5 a paycheck, it's amazing how fast it will grow, and see what it is. So you make a lot of millionaires when people put their money away and they never touch it.
And they have plenty of time to make it compound, so.
Right.
It's great.
All right. We had a lot of great questions for today's webinar. Thank you everyone so much for your participation. I know we weren't able to get around to all of them because we did run out of time, but I just wanted to let you know we will have your contact information sent over to Mary Eileen and Jeff so they can follow up with you on these questions. And their contact information will also be included in the post-webinar follow-up. So if you wanted to follow up with them as well, please feel free to do so. If you'd like to revisit this presentation, again, it will be available on demand in the next few days, and you will get an email notice when it's ready. Also in that email, in case you were missing that handout sheet, that came along with your pre-webinar reminder. So if you want to go back and download it in there, otherwise I will be including it in the wrap-up email. On behalf of Cranes Cleveland Business and Ahola Corporation, I would like to thank everyone for attending, and we hope you have a great afternoon.